Welcome to Deloitte's Debriefs webcast series in Asia Pacific. Our webcast today is from our Geography Update series and is titled The 2025 Japan Tax Reform Striking a Balance. My name is David Bickle and I'm a corporate tax partner based in Tokyo. And it's my pleasure to be hosting this webcast today. And I'm delighted to say that I have with me here Brian Douglas, Naoko Hattori, Takuma McNee, and Masaki Miura joining me as presenters. Masaki is a tax partner and he leads our grants and incentives practice here in Japan, which you may see referred to elsewhere as GI3, standing for Global Investment, Innovation and Incentives Practice. And Naoko is a director in our indirect tax practice, specializing in the constantly evolving world of Japanese consumption tax. And lastly, but by no means least, we have Brian and Takuma, who are managing directors in our business tax and transfer pricing teams, respectively. And all of us are based here in Japan, in Tokyo, working from our main office, that is when we're not working flexibly from home. And for further details, you can access our bios, which you should be able to see on the left-hand side of your screen. Now, before I introduce the agenda for today's webcast, I'll take just a moment to highlight the feature of the webcast. Everything here is on listen-only mode. So if you have content-related questions, you can submit these at any time in the Q&A box, which you should be able to see at the bottom right-hand side of your screen. And we will do our best to respond to those questions during the course of today's presentation. Secondly, all PC users can maximize or minimize the boxes at their convenience during the webcast. And you may also use the icons at the bottom of the screen. And if you want to download today's slides for future reference, please go to the the downloads and links box again, which you should be able to see clearly on your console. Alternatively, if you're joining us today on the move and viewing from a mobile device, you can see all of the slides on today's screen and respond to the polling survey questions as well. And thirdly, if you require an attendance record for this event, you will receive an automated email with a CPD certificate after viewing for 50 minutes. Okay, so let's turn now to the agenda and the theme of today's event and the topics we're going to cover. As I said at the beginning, once again, to remind you of the title, today is about the 2025 Japan tax reform proposals, striking a balance. And I think people would agree that it's been pretty common for a number of years now to hear the world increasingly described as a volatile, uncertain, complex, and ambiguous place. And the geopolitical events of recent weeks that we've been seeing unfolding on the news have merely served to underline the truth in that sentiment. Japan, of course, like all countries, finds itself having to make tax policy in the face of competing pressures. Some of these are external and global, whilst others are internal and domestically focused. At the global level, we continue to see developments driven by at the multilateral level, the OECD, in connection with pillars 1 and 2, which are causing Japan to crystallize their own plans, their domestic plans, to legislate for the introduction of UTPR and QDMTT, and we'll be hearing more about that later in today's webcast. And at the local level, we've also seen Japan respond to its own geopolitical assessments of the situation with plans to increase its tax rate in order to fund an increase in defense spending. So referring to the screen you can see in front of you and looking at the topics today, we'll firstly cover the corporate tax rate, and as I mentioned, some changes there to fund defense spending. We'll then go on to look at credits and incentives. And after that, some changes to the rules around the treatment of leases in Japan, finance leases and operating leases. And from there, over to the OECD initiatives that I just mentioned around pillars. Well, first of all, pillar 2, and then coming back to pillar 1. And hopefully at the end, we'll have a little bit of time left over to cover any questions that have come in during the course of today's webinar. Okay, so with that as our agenda today, Brian, I think that's enough from me. If I can invite you to kick us off, please, by explaining the changes that are happening that are going to impact on Japan's effective rate of income tax.
Sure, thanks, David. Well, with Japan keen on strengthening its self-defense capabilities, Japan is proposing to introduce a new national tax that's going to be called the Special Defense Corporate Tax. And the impact of this is that corporations will see is that their effective tax rate is going to increase by about 0.9%, slightly less for companies that are considered, small and medium-sized. And this new tax will take effect for fiscal years starting on or after the 1st of April, 2026. Now, the way this tax is going to function, it's going to function as a kind of surtax of 4% that is applied on top of the national corporate tax liability of 23.2%. And the proposal indicates that a filing and a payment deadline for this new tax are going to be the same as for national corporate tax. However, it's not clear whether this will be a separate return filing or, similar to other types of surtaxes, whether this special defense corporate tax will actually be included as part of the national corporate tax return itself.
And I think we first heard the idea mooted in Japan to increase the tax rate as a way of funding increased defense spending back in the 2023 tax reform. And for a little bit then, more than a year, things seem to have gone quiet, but now it seems like the government is back on track with this initiative and ready to move forward to implementation.
Yeah, that's right, David. And also in 2023, there was some discussion about increasing the individual income tax rates to help fund the defense capabilities. However, we don't see any mention of the increase to the individual tax rates, only the increase to the corporate tax rates in the 2025 proposals.
Yeah, I think it's pretty easy to imagine the political difficulties of putting up the individual tax rate at this time, at a time when the prices of basic necessities like food and energy are spiking. I saw some statistics indicating that in the month of January, so just gone, the prices for those items, which are obviously heavily import dependent, so greatly impacted by not really demand, but greatly impacted by the weak yen. The increase in those prices, inflation that month was almost 9%. So unfortunately for the Japanese government, there's not really much comfort there either that this inflation is spurring consumer demand. It's really, I think, down to the weak yen. Okay, anyway, shifting back to our focus on companies, I guess the increase in the effective rate of corporate income tax is going to mean that there are going to be some tax accounting issues that are going to be impacted by this, and companies are going to need to consider the implications for.
Yeah, that's right. So assuming this special defense corporate tax is enacted, which could happen at the end of March, end of this month, corporate taxpayers will need to review their deferred tax assets and liability balances and update for the increase in the effective tax rate, at least with respect to any balances that will reverse after fiscal years starting on or after the 1st of April, 2026. So, even though this tax will not apply until 2027, at least for a calendar year taxpayer, some action may need to be taken during the second quarter of 2025 to the extent there are material deferred tax balances. Also, I think taxpayers should not look at this proposal on its own when reviewing their tax accounting calculation. There was a proposal in 2024 tax reform that could impact the corporate entity's effective tax rate also, and this relates to changes to the scope of the local enterprise tax. And in this reform, which has already been enacted into Japanese domestic tax law, will come into effect at the same time as the defense tax year starting on or after 1st of April 2026. And as a little bit of background, the local enterprise tax includes two separate taxing regimes, right? There's one that applies to large companies, which we call the factor-based enterprise tax, and it includes an income tax with a rate of about 3.78%. And then there's another regime that applies to small and medium-sized enterprises, which includes a tax rate of about 10%. Now, while the tax rates are going to remain the same, the definition of a large corporation is what has changed due to the 2024 tax reform. So currently, a large corporation is simply a corporation with stated capital of greater than 100 million yen. Now, this definition is going to expand to include corporations that have total capital of 200 million yen or greater. Have greater than 200 million yen, and are wholly owned, whether it's directly or indirectly, by a parent company that has total capital of more than 5 billion Japanese yen. So what this is to mean is that some companies that are currently considered SME for enterprise tax purposes, or small and medium-sized for enterprise tax purposes, they're going to be pulled into the definition of a large corporation, and that will have an impact on their overall effective corporate tax rate.
Okay, thanks very much for that, Brian. And I think at this point, I'd like to take a little bit of a pause from us speaking and go to our first polling question, which you should be able to see now on your screen and respond to. And the question is, within your corporate structure, does the 100% owner, and that's direct or indirect, does the 100% owner of a Japanese subsidiary or a branch office, also included if you have a branch office, does the subsidiary or branch office have a total capital of over 5 billion yen, which is approximately $33 million? And if it is a branch you're looking at, then we're obviously not talking about the branch itself. We're talking about the overseas company which has the branch in Japan. And your options here are yes, over 5 billion, or no. The third option being our corporate structure does not include any Japan subsidiaries or branch offices. I mean, Brian, I guess this is really a litmus test, this question, to gauge whether or not inbound investors are right to be concerned that their operations are going to be impacted by an increase in tax under a change to the enterprise tax regime. Do you think this change is going to impact on a large number of your clients, your Japanese corporations?
Yeah, well, I think 200 million yen, which is about $1.3 million, and 5 billion yen, which you mentioned, is 33 million US dollars. I don't think these are substantial amounts for many foreign multinational companies. So I would expect that many companies would meet these thresholds. And yes, so I do think the provision will impact several companies here in Japan. And just to be clear, if the company's already considered large, then there would not be any impact. And I see we got some of the results here. And it looks, well, actually, it looks like the majority, still, I guess we're still getting some, sorry, I don't see, are the results published?
Yeah, I've just come up on my screen now, and
Okay.
It looks like about one third of our respondents saying they're going to be impacted. And in terms of, it's roughly evenly split, about one third yes, one third no, and then the remaining third, a combination of no impact or don't know.
Okay, so maybe a number of companies will be impacted here according to this short poll. And I guess one more thing I'd like to emphasize is that, companies should really determine whether this new enterprise tax change will impact them. While it doesn't apply until 2027 for calendar year taxpayers, it can have an impact now. So for example, changing the tax
And
provision.
Brian, I'm not sure if, sorry, I think I may have lost connection here. Can you just indicate verbally if you can still hear me? If you can, we'll carry on, but I've lost video.
I can hear you fine. Yeah, David. Yes, I can hear you. So, yeah, I was mentioning that this could have an impact now. And
okay, can you still hear me? Sorry, sorry, everybody who's listening in. We'll carry on as best we can. So, Brian, look, if we can just add a little bit more background. As you said, the local enterprise tax rate will reduce when a company gets pulled into the definition of a large corporation, which is certainly a benefit to the corporate taxpayer. However, large corporations are also subject to some non-income based taxes within the enterprise tax regime. And that includes a value added tax, which is nothing at all to do with European VAT and indirect taxes. It's a component of the factor-based enterprise tax. And in addition to that, value-added tax is also a capital portion as well. So whether being considered a large corporation is beneficial from an overall cash tax perspective, I guess, is really going to be very much dependent on the specific circumstances of each individual taxpayer. And there's not some magical formula that we can use just to give a clear bright line test of one way or the other.
That's right. This is not necessarily a positive or negative thing for companies. It's just a matter of understanding, which taxing regime they will fit into from 2027 and onwards. And now, since we're on the topic of changes to corporate tax rates, there's also a minor.
Brian, are you still on? I don't seem to hear you at the moment.
I am still here. Hopefully everybody can hear me. Just one minor proposal here regarding the that only impacts certain SMEs that have a large amount of taxable income. They will see their corporate income tax increase, at least in the lower bracket, by about 2%. But as this only applies to the first 8 million of taxable income, it shouldn't have a significant impact on most multinational in Japan. Okay, so we may have the David, but I think we'll move on to talking about credits and incentives. So I think there's been changes to legislation. Government credits and incentives is often can be quite granular. But as a topic, it's we increasingly see companies into as they formulate their suite agendas around climate and sustainability, and the search for growth via new business initiatives and expansion. So with that, maybe it's time to bring in Mira-san. Let me, can you share your thoughts on what you're currently talking to clients about?
Yes, thank you so much, Brian. So today I would like to briefly share 2 points with the listeners. One, an overview of the grants and tax incentive landscape, and two, an easy way to reach Japanese incentives using Deloitte Japan's web tool. So the first topic is that an overview of the grants and tax incentive landscape in Japan. And here is the list of the major tax incentives currently available. And some of them are revised and extended in the 2025 tax reform. And those are the incentives from central government, but we also have incentives from local government as well. And in addition to that, we have cash grant scheme from the both central government and the local government. So there are 4 dimensions. And as you can imagine, these benefits are typically tied to investment in equipment or employment. And some incentives require you to submit a business plan to the government and get approval before making such investments, while others do not.
So, David, are you back?
Yes, I am. Can you hear me?
Okay. Yes. Perfect.
Okay. Thanks, Brian and Masaki, and sorry to our listeners for that, IT. Masaki, thanks very much for giving us that introduction around grants and incentives. Beyond that general comment, can you just tie this into which of the incentives we're seeing either modified or extended under the 2025 tax reform?
Okay, sure, David. So, for example, in this list on your screen, the tax incentives for regional future tax investment was revised and extended in the 2025 tax reform, which requires submitting business plan to local government and then obtaining confirmation from the central government as well. And these incentives can be utilized by those companies with foreign headquarters, as Japan has been trying to measures to Japan has been introducing measures to encourage investment in specific areas such as semiconductors, decarbonization, data centers, and other investments that will improve productivity. And maybe some of you may think there are very few opportunities for companies to take advantage of the incentives in Japan, especially for foreign companies. I would say this is not true. It may not be widely, known. The Japanese government has trying to attract investments, inbound companies, as their investments are crucial for revitalizing Japan. And in recent years, there have been cases where inbound companies successfully obtained several billion US dollars in cash grants from the government. While this is not happening frequently, I can say that inbound companies should now consider the opportunities for utilizing Japanese incentives.
Yeah, and Masaki, so why do you think it is that, in the past or until recently, particularly inbound investors haven't been availing themselves of the various incentives and grants that are on offer here in Japan?
Yes, that's a good question. And there can be various reasons for this, such as a lack of awareness about the incentives and complicated application processes, and the perception that these benefits are hard to obtain, and most importantly, the language barriers.
Yeah, okay, the ever important language barriers as well. Okay, well, look, I think given the weak yen, there's certainly been a lot more interest of late in investment into Japan as a destination, and I think we'd like to take this opportunity today to quickly test that hypothesis about the strength of interest and investment in Japan, and hopefully this time our polling tool is not going to kick me out of the presentation. So the question posed to you is your organization currently considering an investment into Japan? And four options there. The first one being yes, we are considering a new investment. So a greenfield investment, if you like. Second option, yes, we are considering expansion, which would be a brownfield investment. Thirdly, no specific investment, but we are interested in exploring opportunities in the future. And then lastly, number four, nothing being considered at the moment. So Masaki, once again, whilst we wait for the results to come in, I guess regardless of where companies are in terms of their decision making, it's absolutely crucial that they don't leave analysis or consideration of incentives to being an afterthought. Very important that they incorporate this into the initial design phase thinking, the initial feasibility phase thinking, rather than leaving it to much later once they're at the detailed design stage of their planning.
Yes, that's definitely true. Yes, that's definitely true. And at Deloitte, we have a dedicated team that can help with that. But even before that, we launched a site last year called Japan Incentive Insight. This site allows users to search for major national and prefectural incentives in Japan by setting search criteria, and it has already been used by many foreign companies. And it is often utilized when formulating investment plans or when considering measures to improve ROI through the usage of incentives. And this site is publicly available for free and does not require membership registration. And as a result of launching Japanese Incentive Insight, we can now deliver information about Japanese incentives to a much larger number of foreign companies.
Okay, and I think that's something we have details on the dashboard for those that are interested. We've seen the results have come in, and maybe my optimism was a little bit misplaced. I think the numbers are changing as people still continue to vote, but it looks like about 80% in aggregate are either not considering investment into Japan or have no specific plan. Fortunately, half of that, though, more than half of that, though, 45%, although no specific plan, they are interested in considering in the future. And so the remaining 20% no is split roughly equally between greenfield and brownfield. I'll take that as a positive, though, that even though people don't have concrete plans at the moment, Japan continues to be a destination where they feel that it's worth investing, and that must be for business reasons, and they think that it's an advantage to being here. Okay, well, it seems there are, at least particularly for that group who don't have a concrete plan now but are interested in investing in the future, I think the tool Japan Incentive Insights could be quite useful at the preliminary stage. Can you just quickly explain? I think we have a graphic to come up on a screenshot of the dashboard you see when you log on the website. Can you just briefly explain how we can quickly use this tool to figure out what's available in terms of incentives and cash grants, things like that, to a company that's looking to come into Japan to invest?
Yes, thank you so much for giving me these opportunities. And David and listeners, no worries about that. It is very simple to use. If you search for Japan Incentive Insight or Japanese incentives on the internet, the relevant page should appear at the top of your search result. And the page should be displayed in English by default, but if it appears in Japanese, you can switch to English by selecting the language option at the top right of the page. And after that, you can either enter keywords of interest into the search window or click on advanced search at the bottom of the screen to narrow down search results by investment locations, industries, etc. And once the search results are displayed, you can click on the name of the incentives to access detailed information. Additionally, we provide specific examples and explanations of noteworthy incentives on our blog, so please check those out as well.
Okay, thanks, Masaki. And clearly, well, we hope it's of use to people looking to come into Japan for the first time. Anecdotally, I know a lot of groups, organizations who are already here who've been using it to do a sense check, if you like, on their current arrangements, making sure that there's no cash, if you like, that they're leaving on the table. So it can also be used in that way. But thanks very much. Okay, I think I'd like to pivot now away from grants and incentives. Thanks very much for your involvement there, Masaki. Brian, if I can come back to you again, please, and just looking back at what's in the 2025 tax reform for corporate investors. Perhaps you can take us through what else we've got here. First up, leases.
Sure, yeah, I think, yeah, as you mentioned, another topic to discuss is leases and lease taxation and accounting. And just to level set in simple terms, we generally deal with two types of lease arrangements in Japan, right? We have operating leases, and these are kind of the simple leases where both the lessor and lessee recognize lease revenue and lease expense on their P&Ls. And then we have finance leases, and these are leases that meet certain conditions, and the lessor and lessee will treat this lease arrangement as a sale of the lease asset, and the lessee will include that asset on its balance sheet and depreciate that over time. Now, in the 2025 tax reform proposals, there's going to be some changes that impact both operating and finance leases.
Yeah, and I think just at this point, if we can just pause again for a moment for one more polling question, and this is the last one we'll do today. Just want to test the level of impact on listeners today from these new rules around leasing. So the question is to you whether your Japanese subsidiary or branch office is quite simply party to a lease arrangement in Japan or not. So option one being yes, we are party to an operating lease. Option number two, yes, we are party to a finance lease. Option number three, we're party to both operating and finance leases. And number four, no, not party to any lease. And five, don't know. And well, while we're waiting for the results of that to come in, Brian, I understand that this change in the tax rules that we're seeing proposed in the tax reform proposals is driven by changes that have occurred in relation to the accounting rules in Japan for treatment of leases.
Yeah, that's right. So one of the most interesting changes was that last September, the Accounting Standard Board of Japan released a statement indicating that all lease arrangements, even if currently considered an operating lease, well, this should be treated as a sale and recorded on the books of a lessee as it are finance leases under current rules. And this will take effect for years starting on or after April 1st, 2027, although the rules indicate that early adoption is possible. So now the government in this tax reform is looking to tweak some of the tax rules in response to the revisions that were made under the accounting rules going forward. And if we start with or let me see, take a pause here to see if we have the results in.
I don't know if they're showing up on your screen, but I can see here that we've got actually quite a lot of impact. So 40%, just over a fraction over 40% of respondents today have an operating lease, down to around 5% for a finance lease though.
Okay, yeah. So I think these new rules in accounting and in tax are going to have an impact on several companies here in Japan. And if we can talk about the proposals to the operating leases first, the reform clarifies that lease payments with respect to operating leases will be deductible for corporate tax purposes.
Yeah, I mean, and that's desirable for, well, it's great. That's desirable for companies to be able to get a deduction, but that sounds pretty similar to the current rules, the current regime where deductions are available for operating lease expenses.
Yeah, that's right. So there's not expected to be a change to the way companies treat operating lease payments, at least from a corporate tax perspective. Right? Under current rules, operating lease payments would be typically expensed for accounting purposes. And since there's really no specific tax provision dealing with the treatment of operating leases, the tax treatment will follow the accounting treatment and it'll be deductible for corporate income tax purposes. However, because of the new accounting rules, we no longer have this lease payment expensed on the P&L for operating leases. So the government wants to make it clear that lease payments for operating leases will continue to be deductible for corporate tax purposes.
Yes, thanks for that, Brian. And I guess the key takeaway is that going forward, and that's assuming that the proposals are actually approved to come into law, companies with operating leases then are going to generate a new booked to tax difference, which is really good, something that's going to impact on their deferred tax accounting going forward.
Yeah, and I think that's the point we want to stress here. And tracking that difference can be complicated. We provide a simple example on the slide to illustrate this based on certain assumptions. And I won't walk through this example, but you can see that differences arise due to interest expense and depreciation expense being recorded for accounting purposes, but for not for tax purposes under these new rules.
Okay, what about changes then to the tax treatment of finance leases?
Sure. Well, there's some mechanical changes in the way depreciation is calculated for certain finance leases. Also, under current rules, a lessor that's a party to a finance lease has the option of deferring part of the revenue expense from the deemed sale of the lease asset for corporate tax purposes. However, the reform proposes to abolish this option, so suggesting that taxpayers will need to now recognize 100% of the revenue at the time of entering into a finance lease agreement. Now, to allow corporate taxpayers to kind of ease into this new rule, there will also be some transition rules for finance leases that are entered into before March 31st, 2027, and whereby a taxpayer can recognize that sales revenue over a 5-year period. And also, just to make things a little more confusing, there are similar yet different transition rules that apply to Japanese consumption tax treatment of finance leases. And maybe I can ask Naoko to shed a little more light on this from a consumption tax perspective. Naoko?
Yeah, sure, Brian. So from a Japanese consumption tax or JCT perspective, the timing of recognizing taxable sales and JCT on finance leases will be changed in line with corporate income tax. However, as Brian mentioned, the transitional measure for JCT is somewhat different from corporate income tax. For example, for JCT purposes, the taxpayer may recognize sales from finance leases over 10 years period as opposed to 5 years for corporate income tax purposes. Therefore, adjustments may be required when preparing a JCT return.
Thanks for that, Naoko, and also thanks for the addition of operating and finance leases. Naoko, whilst we have you here now and you have the mic, maybe we can talk a little bit about some of the other proposed reforms that are going to be impacting on indirect tax in Japan, impacting on JCT, the Japanese consumption tax.
Yes. So I'd like to discuss possible future change of JCT regime regarding the cross-border e-commerce. The tax reform proposal for 2025 indicated the possible extension of the platform taxation to sale of goods.
Platform taxation, something introduced last year in the 2024 Japan tax reform proposals. Can you just give us some background or some extra color on how it's going to be, how these rules around platform taxation are going to be extended?
So in the 2024 tax reform, the platform taxation was introduced for the provision of digital services by online marketplaces. As a result, if a foreign supplier sells digital contents to Japanese customers via online marketplaces, the marketplace operator, such as Apple or Google, will be responsible for reporting and remitting JCT on the digital content. The 2025 tax reform proposal indicated that the government is considering introducing measures to secure tax revenue on the sale of tangible goods by online marketplaces. This is on the basis that the e-commerce market in Japan has been rapidly expanding since COVID. How to ensure JCT collection by foreign suppliers and create a fair tax environment for domestic and foreign companies has become a new challenge to the government.
Thanks for that, Naoko. And so how would the possible changes affect market operators?
So when overseas suppliers wish to sell goods to Japanese customers via marketplaces, typically there are two possible supply chains. One is that the supplier ships goods to a warehouse located in Japan in advance, stores the goods there, and sends them to customers once a purchase order is received. The other scenario is that the supplier directly ships goods to Japanese customers when the purchase order is received. In the first scenario, the sale of goods will be subject to 10% or 8% JCT, but often the supplier does not report or remit JCT. it is very difficult for the government to pursue all foreign suppliers that do not comply with JCT obligations. So given this situation, the government is considering shifting the JCT obligations to marketplace operators. If this change is introduced, marketplace operators will be obliged to report and limit JCT on the sale of goods via their marketplaces. In the second scenario, import JCT applies at the time of import clearance by the buyer. However, import JCT is exempted for goods with low customs value, which is 10,000 Japanese yen or less. This can lead to a number of goods entering into Japan without the payment of import JCT. To improve the situation, the government is considering the abolishment of import JCT exemption for low-value goods. We still do not know what measures will be actually implemented or when the change will actually happen. However, similar measures have already been implemented in other countries such as UK, EU, Australia, and Singapore. So considering these global trends, it is a matter of time that the Japan government announced a new regime to ensure JCT collection for trading on goods on marketplaces.
Yeah, thanks very much, Naoko. And these changes are going to become increasingly important, I think, as we see this extension and development of the digital world. Okay, so thank you for that, Naoko. And coming back to some of the other proposals in the tax reform, no update would be about looking at what's been going on in the world of the OECD, and in particular the Pillar 2 and Pillar 1 initiatives. Japan has been very diligent about implementing the OECD's global minimum tax regime, also known, as you can see here on the screen, as Pillar 2. Brian, can you, building on what we've already learned in previous proposals in previous years, can you tell us what's new in the 2025 tax reform proposals in connection with Pillar 2 developments here in Japan?
Sure. So Japan continues to follow OECD guidelines, and to complement the income inclusion rule, which came into effect in 2024, the 2025 proposals include the introduction of both the undertaxed profits rule, or the UTPR, and the qualified domestic minimum top-up tax, or the QDMTT. There's also a number of changes to the income inclusion rule just to keep up with some of the additional administrative guidelines that have come out from the or been published by the OECD in the past year. And there's a few provisions on alleviating, CFC or controlled foreign corporation documentation requirements, given that there will be increased reporting due to Pillar 2 compliance. And most of these proposals are expected to be applicable for tax years starting on or after 1st of April 2026.
So if we start with QDMTT, what is Japan actually proposing?
So if we take a quick step back and recall the purpose of the Pillar 2 rules, which is to ensure that large multinational companies pay at least 15% tax on their profits, wherever those profits are generated. And in line with that, in OECD guidelines, Japan's QDMTT will allow Japan to impose additional tax on a Japanese subsidiary or a Japanese ultimate parent entity if that entity's effective tax rate is less than 15%. Now, the proposal indicates that there'll be some safe harbors, but was silent in terms of any details. But we would expect them to be in line with the safe harbors discussed in the OECD guidelines. Excuse me.
Yeah, thanks, Brian. And we've already spoken earlier in today's webinar about the effective rate of tax in Japan being 30 or approximately 30%, depending on the enterprise tax regimes you're subject to. And of course, we've mentioned that the effective rate of tax is going to go up even further with the special defense tax. So, is it realistic that in Japan, entities are going to, or could be at risk from having an effective rate of income tax of less than 50%, this threshold?
Yeah, sorry, David. I think you yeah, the connection wasn't so great, but yeah, I think I understand your point. Given Japan's high effective tax rate, we don't anticipate that there would be many instances where the effective tax rate would be less than 15% in Japan, but it's not impossible, under certain circumstances. For example, where a company will take multiple tax credits and perhaps where there may be some unique and significant adjustments to determine the globe income, as defined under the Pillar 2 rules. Just to list out a few other items related to QDMTT in the proposal, there will be a filing and payment deadline for a QDMTT tax return, which will be due 15 months, or for the first year 18 months after the year end. But no filing is required if there's no QDMT top-up tax. And as we just mentioned a moment ago, we don't expect many instances of a top-up tax, so there probably will be very few filings of this return in Japan. However, there is a separate information return filing that will be required. But again, this return filing can be exempted if the Japanese tax authorities can obtain similar information from the taxing authority of the UPE or another designated filing entity from the filing of the global information return.
Okay, and so just a comment from me at that point, and I hope it is possible for you to hear me. Understand from what you said that QDMTT might not be much of an impact to Japanese subsidiaries, given the high corporate tax rate. However, I'm assuming that a calculation is still going to have to be performed, even if, for good governance and best practice, even if just to demonstrate and document that the effective rate of tax is indeed greater than 15%. So is this something that Japanese subsidiaries, we expect Japanese subsidiaries to handle themselves, or would they more likely leave it to the ultimate parent entity?
I hear you loud and clear that time, David. Yeah. So perhaps this is going to be a company by company decision. I'll note that the OECD guidance regarding QDMTT provides that countries can choose whether to use local accounting standards or the accounting standards used by the ultimate parent entity for the purposes of the QDMT calculation. The Japan proposals didn't indicate which standard Japan will use. However, if it does adopt Japanese GAAP, then it's plausible that the Japanese subsidiary would lead this calculation, presumably because it has more familiarity with Japanese GAAP adjustments.
Okay, well, thanks for that. And that's QDMTT. In terms of the other developments, let's move on now and think a little bit more about UTPR.
Sure. So the way UTPR works is that it would allow Japan to additionally tax a Japanese subsidiary where another constituent entity within the multinational group paid less than 15% tax on its income. And also the UTPR functions as kind of a last resort to achieve the objective of Pillar 2. And what I mean by that is it only comes into play where other taxing provisions of Pillar 2, such as the income inclusion rule and the QDMTT, don't apply to top up the tax of a given entity.
So just thinking practically again, given that the UTPR is, as you say, a last effort to ensure 15% taxation, and given that many other countries have implemented the income inclusion rule and QDMTT, do you expect that in Japan, that the UTPR as a last effort, a last-ditch attempt to get that 15% rate is going to come into play often here in Japan?
Well, I think UTPR will apply under certain circumstances, assuming these proposals become law as is. Well, you're right, there are a number of countries that have implemented IR and QDMTT, but there's some significant countries that have not, such as the US, China, and on the slide here, we have a couple of very simple examples to help us determine whether UTPR will or will not apply here in Japan. So I'd like to run through these briefly just to highlight the cases where this could apply here in Japan. So each case is similar. We have a small multinational group consisting of a ultimate parent entity in country A that has subsidiaries in country B and in Japan. And in case 1, we have a low-taxed entity in country B. And since country A has an IIR, right, that subsidiary's tax will be topped up via the IIR mechanism. So UTPR in Japan wouldn't apply in this case. Moving on to case 2, which the only difference from case 1 is that country B has a QDMTT. So in this case, it's the country B that will top up the tax of this if it's subsidiary. And again, UTPR doesn't apply here. Now in case 3, which is similar to the first case, but in this case, the UPE also has an effective tax rate of less than 15%. So in this case, UTPR would not apply with respect to the income of the subsidiary in country B, because that again gets taxed by the IIR mechanism of country A. But UTPR in Japan will apply to the income of the UPE since its ETR is less than 15%, and there is no IIR or QDMT to apply to that income. And finally, case 4, which is similar to case 3, except country A does not have an IIR. So this could be an example of the US or China. And here we have the UTPR in Japan applying, not only to the income of country B, but also to the UPE as well here. So there's a couple of scenarios where this could come into play here in Japan.
Thanks, Brian. And hopefully people can they've got access to the slides afterwards and can think through and work out in their own minds, get comfortable how these rules come together. But just staying on that point about the UTPR. So if the UTPR applies, how would the Japanese entity calculate that UTPR?
Yeah, well, I think it's unlikely that the Japan entity itself would determine the amount of top-up tax under UTPR. Basically, any top-up tax under this rule should be calculated on a group basis, and then it would be allocated to the various constituent entities that are located in a jurisdiction that has implemented the UTPR rule. And in that allocation, it would typically be based on the number of employees and assets in those jurisdictions.
Okay, so I guess this would more likely be a task of the ultimate parent entity, as it should have access to all group information needed to determine the top-up tax and to allocate the appropriate amount to the constituent entities, I guess.
Yeah, I think that's exactly right. And maybe just to close off here, just a few more items about the UTPR and the proposal. So the proposal did not provide for any safe harbor rules. So we'll need to wait and see if more guidance comes out on those. However, there are some transition rules for companies that are newly expanding overseas. And also the proposals include, reporting requirements similar to the QDMTT, right, with a due date of, 15 months after the year end, 18 months for the first year. There was no information as to, what these filings would entail, but it did mention that, if there is no top-up tax allocated to Japan, then there would be no filing necessary.
Okay, thanks for that, Brian. And I'll just chance the sound quality by bringing the video back on again. Hopefully the sound quality will stay there. But thanks for that on Pillar 2. There's clearly been a lot of discussion really over the last 18 months, 2 years around readiness for Pillar 2. But of course, there have also been developments in relation to Pillar 1. So Takuma, thank you very much for your patience in waiting. But if I could bring you in here, please, and if you could give us a quick update on what's been happening in the world of Pillar 1 as well in Japan, that would be most appreciated.
Certainly. Thanks very much, David. So as you just heard, the implementation of Pillar 2 in Japan appears to be moving forward steadily. On the other hand, Pillar 1 Amount B in particular is much less clear. I would now like to provide you with an update on Amount B from a Japan inbound perspective. But before I do, I just want to quickly refresh everyone on Pillar 1 Amount B and its latest OECD developments to make sure that we have a good global context. So Pillar 1 Amount B is an initiative of the OECD, and it's an important development for creating tax certainty in market jurisdictions whilst reducing administrative burdens to both tax authorities and taxpayers, or what the OECD refers to as the simplified and streamlined approach. In certain market jurisdictions, however, it has faced challenges, particularly from jurisdictions which rely upon tax revenues of entities subject to Amount B. That is, the proposed simplified target returns for distributors may be considered by some jurisdictions to be too low. Despite these challenges, in February 2024, Amount B was released. Subsequently, the OECD released various other materials, which are summarized on screen in the blue box. So, as I stated, February 2024, the final Amount B report was released. Subsequent to that, in June 2024, we had the definition of qualifying and covered jurisdictions. In September, the Model Competent Authority Agreement, and then in December, the fact sheet and pricing automation tool. So very busy year for them. Finally, from January 2025 was the official implementation date of the Amount B. Nevertheless, additional guidance was then, or I shouldn't say additional guidance, the consolidated guidance of Amount B was then released in a couple weeks ago at the end of February. From my perspective, there are really two key features in the final report, which are important to future developments as we have now crossed the implementation start date. The first is that Amount B is not mandatory, and the second is that it's not binding. These are two important features when we think about how Amount B will impact foreign multinationals with distribution activities in Japan. So, what is the current status of the implementation in Japan, given that Amount B implementation actually began 2 months ago? Well, in a nutshell, Amount B is not implemented. However, international discussions and developments of other countries are being closely monitored, and ultimately, there is a view that political commitments do not require legislative change, and Amounts A and B are considered as a package. So, what does this mean? Amount B will not be implemented in Japan immediately. When it is, implementation will be through a multilateral instrument rather than legislative change in Japan. And finally, in the interim, Amounts A and Amount B could become a de facto floor operating margin. So when we think about the largest market jurisdictions in the world, other than US and China, Japan is often the next most important market for many companies. As such, for Japan inbound direct investments, i.e. Japanese subsidiaries of foreign multinationals, no Amount B in Japan means continuing tax uncertainty for an important market jurisdiction. Therefore, as of now, robust documentation or potentially an APA will continue to be the most prudent approach given the ongoing uncertainty for market jurisdictions such as Japan. I'll now turn back over to you, David. Thank you.
Oh, do we have David?
Not sure, but Brian, do you
Yep.
see any questions there?
I think we're up at the. Oh, there's David.
Yeah, sorry guys, the gremlins are certainly impacting today. Takuma, thanks for holding the fort there and talking about Pillar 1 Amount B. I guess I know you're a very eloquent speaker on that, so I guess you would have shared some of your thoughts with our listeners today. Unfortunately, with thanks to all of you for dealing with our glitches today, Brian, Naoko, Takuma, and Masaki, that brings us to the end of today's discussion. I think there's been a couple of interesting questions. So I think we've got just a few minutes, and while you have the mic, Takuma, just one question, if we can cover this as it relates to APAs and Pillar 1 Amount B. Quite a brief question, and it's so how, just paraphrasing, how will APAs be impacted by Pillar 1 Amount B implementation?
Thanks, David. Really good question. I think this is really going to be two questions, though. I would probably separate this into in-force APAs and APAs under negotiation. So when I think about in-force APAs, we don't expect any significant impact from Amount B. And if we think about APAs under negotiation, it really comes down to what is the current status of Amount B implementation in Japan. So as of now, since it's not implemented, no significant impact on negotiations of APAs. However, once it is implemented, we would expect there to be some impact on APAs. Of course, this will all depend ultimately on what is the implementation mechanism, as well as any updates to the relevant treaty governing that APA. So still uncertain.
Okay. Still uncertain, so definitely something to continue to watch and monitor carefully. Okay, well, that really is unfortunately all we have time for today. So once again, thank you, Masaki, Takuma, Brian, and Naoko. And special thanks to all of you, our attendees, for joining today. And once again, I'm very sorry for the disruption due to technology issues. We'd be very grateful if you could fill out the survey that you should shortly see appearing on your screen, popping up, and tell us what you think about today's program. If you did join us late, please note that this presentation is going to be archived for future viewing. And if you think others would benefit from listening and viewing to the webcast, then please do share it with them. And you can do this via the share this icon, or have them simply visit the Dbriefs site. Those of you that have questions that we couldn't get to today, we will respond to those. We'll respond directly to you with answers within the next week or two. So appreciate your patience on that. And of course, if you think of any other questions in the period, please hesitate to reach out to me or to any of our speakers on today's call, and we would be delighted to speak with you. I'd also encourage for regular and Debriefs listeners, please do join us for our next Debriefs, and that's on the 11th of March, 3 p.m. Singapore time. Also in the Geography Update series and titled Hong Kong SAR Budget, the 2025-26 commentary. So with that, at last, from all of us here at Deloitte, thank you for your participation today in Deloitte's Asia Pacific webcast. Goodbye.